Welcome back. We want to take some more time to talk about the inverted bond market and the analysis of bond yield curves. Now, there was a great question that was posted in our last video that actually speaks to the crux of what we're talking about here. And the question is, why does the bond market invert, at all? And if we consider, we're taking a look at now a normal yield curve where we have the maturities below, that 1 month, 2 month, etc. And we can see over time as we move from the short maturities to the long maturities all the way to the 30-year, the yields tend to increase. The bond market, for a trader to buy a longer maturity bond, the bond market has to offer a higher yield. Otherwise, there'd be no incentive. If you can make 1% with a 1 year, why would you buy a 3-year or a 30-year with a 1% as well? Now, in a normal market condition, again, the longer the maturity, the more yield each bond will tend to offer. But the question is, why does a bond market invert? Now, if we consider we're in a normal economy and then all of a sudden, or over time, the numbers start to look not so good. The fundamental numbers look pretty bad. Durable goods declines, the housing market declines, growth and jobs, everything starts to turn to the downside. Well, traders don't have as much confidence in the market, and obviously they'll sell stocks. The stocks move in anticipation of higher or lower earnings. Well, bonds and interest rates move in anticipation of higher or lower, greater or worse macroeconomic conditions. Now, of course, traders have full faith that the U.S. Treasury will be able to fulfill their obligation and repay the bonds, but relatively speaking, when the economy turns from good to bad, the expectation goes down a little bit. Now, it's still to say we all still anticipate the U.S. Treasury will be able to fulfill their obligation to repay whatever we spent on buying a Treasury bond. But the fact of the matter is, over time, as economic conditions worsen, that turns a little bit to the downside. Now, eventually we see what's called an inverted bond market yield. And this is where the shorter term bonds, like the 1-year bond, pays a 4.08 and the 30-year bond pays a 3.5. Now, why does this happen? Bond yields go up when the actual price of the bonds go down. So traders are not confident about the near-term future. They may be very confident, will the U.S. Treasury be able to pay back the bond obligations within 30 years? Absolutely yes. 10 years? Absolutely yes. 1 year? Absolutely yes, but maybe not as much as the longer term outlook. So it's just a statement in terms of a financial representation. How much confidence do we have that the bond will be able to be repaid, or the Treasury will be able to fulfill their obligation, to pay back the bond, the principal plus interest? Now, of course, nobody has any sort of fear that the U.S. Treasury won't be able to pay back their obligations on a 1-year bond. It's only paying a 4.08, 4.0% interest rate. If you have a country that has a very high risk rating, that has a very strong chance of defaulting, you may see 1-year bonds paying 25% or 30% interest rates or something along those lines. That's not, of course, where we are, though. But the reason why the bond market inverts is because the expectation, at least in the near term, over, let's say, the next 1 year, it's a little bit more risky than the risk we're taking for a 10-year bond or a 30-year bond. And it doesn't happen very often. I mean, on the day-to-day basis, we see stock markets go up and down, and the expectation doesn't really waver, unless we come into a situation where the economy really looks like it's turning to the downside. And the last time we spoke, the last video regarding bond markets, the inverted bond market curve, this has only happened maybe 4 or 5 times in the past 30 years. So it is a very significant event, and it coincides with some of the biggest stock market crashes we've seen in the past 30 years. The dot-com bubble in 2000, 2001, the housing market crash of 2007, 2008. Now, I happen to be to subscribe to the theory that we have 7-year cycles, that stock markets crash and then regain their might every 7 years. So we had a crash and we had a recession in 94 plus 7, that's 2000, plus another 7, that's 2008. and then plus another 7, well, that's 2015. Well, we didn't have a stock market crash in 2015, but we did have a very fast sell-off. And then, of course, plus 7, that brings us to 2022, where we are now. So with that said, I thought it might be helpful to go back and take a look at some of the previous market crashes to see what the bond market looked like at that time. Now, what we're looking at right now is March 2000, 2001. The black line represents the S&P 500. The green line represents the yield on the 1-year bond. And the red line represents the yield on the 10-year bond. Starting on the left-hand side, March of 2000, S&P 500's chugging away around 1,400, 1,500 almost, with not a lot of variation in the prices. Seems to be a nice, sideways trend or consolidation pattern. But notice the 1-year bond, the green line, starts to break above the red line, which is the 10-year bond. Now the 10-year bond regains the top ranking, and then again, the green line is above. The green line more or less remains above the entire time, and then eventually, September 2000, the stock market starts to fall apart, and it really sells off from an S&P 1500 down to an S&P below 1200. That's a pretty significant percentage move to the downside, and that was led obviously by the dot-com bubble imploding. And during that time, notice two things. First of all, the green line stays above the red line until we see 2001, when the 10-year bond yield did go back above. Also notice the trend is to the downside in all cases, meaning the stocks are going down. The 1-year maturity is going down, and the 10-year maturity is also going down. Now, how can we predict the bottom of the market with the bonds? I don't know that there is a way. The inverted bond yield tells us that the capital is moving out of the short-term bonds. It's nervous about the future, the near-term future, more confident about the distant future. Well, that tells us there's trouble on the horizon, and it basically gives a signal that, eventually we're going to see a break in the stocks to the downside. But because the 10-year yield crossed back above the 1-year yield, I do not think that this is a credible signal to buy stocks. We would have to look at other tools like the VIX, the volatility index, for example, to better, more accurately try to find a bottom in the stock market sell-off. I think the inverted bond market yield, or the inverted yield curve, is a signal when the stock market may start going down, and not also when it's going to go back up. Only when it starts to go back down. At least that's, our take so far. Take a look at January 2006. S&P 500, again, right around 1,500. The green line is a 1-year bond. The red line is a 10-year bond. Notice the beginning, mid-2006, the green line breaks above the 1-year. We're going sideways. Now notice two things. The green line then crosses below the red line. So the 1-year bond is below the 10-year bond even before the stock market really starts to sell off. Remember, this is 2000, 2008, 2007, 2008 stock market sell-off. So the trend is to the downside in the yields, and the trend is to the downside in the stock market in the same way it was in March 2000. But notice there are differences. And I think it's very important just, to kind of study the charts and notice these differences. For example, in the year 2000, the 1-year bond yield stayed above the 10-year bond yield through the vast majority of the sell-off. Eventually, the 10 did cross back above. In 2007, and the stock market still had further ways to go down. In 2007, the 1-year bond, the green line, was above the red line, telling us danger, the stock market may go down. But then it's crossed back above, and the 1-year bond really went down, and the 10-year bond sort of held steady, and then the stock market moved down. So the behavior of the bonds after we get this initial danger signal can be different. What remains the same is that under normal conditions, we expect to see a normal yield curve. Short-term bond maturities have a lower interest rate than the longer-term bond maturities. And that when we see an inverted yield curve where the short-term maturity yields are higher than the long-term maturity yields, that shows us danger. But how the market reacts after the fact, that's not as predictable. Now, we look at 2019. Now, again, we have this 7-year cycle where we had, stocks that crashed in 2000, 2007, plus 7 years, 2015, really didn't do anything. Eventually, we did have a big, very fast sell-off. It didn't last very long, and it was accompanied by an inverted bond market yield. Green line represents the 1-year bond, and we can see it tried to break above the red line, the 10-year bond, a couple times. Not so successful until August, September of 19. The S&P 500 continued to climb higher, and take a look. The 10-year bond then crossed back above. It looks like a normal market, but don't forget about the danger sign that we saw, maybe about 4 or 5 months ago. Then we had a very rapid sell-off. So the danger sign is going to, may be triggered, but the stock market may not, correct immediately. It's a warning sign to be on the lookout. It could take 6 months. It could happen immediately. Notice also, by the way, the direction of the yields is kind of flat until, of course, the stock market sold off. And I think the yield selling off at that time, was really following the stock market by that point. But compare that to 2006, 2007, and 8, the yields were going down as the stocks were going down. In the year 2000, the yields were going down as the stocks were going down. Didn't behave that way in 2019. Now, of course, now we fast forward to present day. This chart starts March of 2022 until present day. Green line's a 1-year bond, red line's a 10-year bond, and the 10-year bond, normal economic conditions, the red line's above. All of a sudden, July, it looks like around July, all of a sudden the green line crosses above the red line. We see an inversion, July 12th, in that area. Well, the stock market stayed right near the highs until around the end of July, early August. July, remember, that was just, not too long ago. We had a pretty strong stock market condition. But notice this, the green line is well above the red line. Also, notice this is different. We're trending to the upside in the green line and the red line. The 1-year bond yield and 10-year bond yield are going up. The 1 year is just going up more, relatively speaking. Again, in the year 2000, 2001, the lines are heading lower. The yields are declining. Federal Reserve is cutting interest rates. In 2006, 2007, well, actually 2007, I think we hit, if memory serves, we hit a high on the Fed funds rate, and then we started to cut rates. 2019, well, we were kind of flat. I don't believe that, the interest rates changed at all in that time. But now we're in a different situation. I don't know when the last time that this has happened, that we see increasing yields with a bond market inversion. And that really puts us in a very unique situation in that stocks are selling off, obviously because the Federal Reserve is continuing to raise interest rates to combat inflation. And in addition to that, we see stocks, in addition to stocks going down, we see yields going up in anticipation of higher interest rates. So this presents a very unique situation, at least going back around 30 years. I don't know if we've seen this type of dynamic, occur before. But it'll be very interesting to see. I would not be surprised if the 10-year maybe eventually crosses back above the 1 year. It happened in the past. It happened in 2019. The red line crossed back above. It happened in 2007, 2008. The red line crossed back above, and also 2000, 2001. If the 10-year bond yield goes back above the 1 year, if the red goes back above the green, I don't think that we're out of the woods yet, because we still have this major sell-off in stocks that's predicted, or that we can interpret from the bond market inversion. So we are in quite a unique situation, but the fundamentals do remain the same. And to go back to the question, that why do bonds invert? It's because traders are selling the short-term bonds. They have a relatively smaller degree of confidence in the near term, a greater degree of confidence over the long term, and that's why the short-term yields go up to attract investment capital that just doesn't want to buy, bonds at that point, and they're choosing to hold their investment capital in the longer-term bonds, as a flight to safety. So that's why the bond market inverts, and that's why it's so important, because it only happens every so often, only maybe 5 times or so in the past 30 years, We're looking at that situation now, so it'll be very interesting to see what the future holds for us. We thank you for joining us. We look forward to seeing you back soon.